Hey, ladies and gentlemen, this is Sean here with you. It is Wednesday, or I'm sorry, not Wednesday, Tuesday, the 26th, and it's about 20 to 1. It's in the middle of the day. I was going to do an update last night and decided to wait until this evening to do it, but I've had a little something come up. My grandmother is in the hospital in Roanoke, Virginia, and she's not doing real well. She has an aneurysm on her aorta, and so they're looking at trying to repair that. If you know anything about that sort of thing, it's a very dangerous situation, and so I'm going to be traveling there either this evening, most likely this evening. But anyway, I wanted to go and get this update out of the way and just take a look at our current positions. We haven't been together since late last week, so I want to go ahead and get something going for this week on these trades. But just in case I'll leave town, this evening, and I'm not back for a couple of days. But either way, our trades are going pretty well. We're going to look at these two. We're not going to put anything on new at the moment. The Fed is coming out with the minutes tomorrow. That is likely to cause some kind of little storm one way or the other. So we're not going to do anything as far as a new position right now. But what I want to show you here is our current positions. Remember the disclaimer: everything here is practice trading only. Don't forget that. But the first thing I want to look at is this broken wing butterfly. Now this is a longer term trade, and we talked about this several times. For those of you that are brand new, that are just joining us, here's what we did on this trade. We bought a 1900 puts, sold two 1850 puts, and then bought a 1780 put, and we did that for a 30-cent debit. And there's the fill price, as you can see right there. So, and make sure you jot those down and you're following along with this as we go through this trade. Now, right now, this position here's the 1900 put that we own. So that the market's at 1904 right now, live as we're looking at this. So the market's here at 1904, and our long put is at 1900. So it's right at our long put, and that's perfect. We're totally happy with that. And then here are shorts right here at 1850, and then down here is where we're long again at 17. Let me swoosh this together. There we go, at 1780. There, now you can see it. Okay, so again, just to recap, this is so important to understand. But between 1900 and 1850, that's a 50-point spread that we own. So we own 50 points of potential income. And between our other 1850 short, because we're short 2 at 1850, between 1850 and 1780, we're short 70 points. So we own 50, short 70. That means we're short 20 points total, right? So that's $2,000 risk on a one contract example. And if you look over here at the max risk, it says 2,030, and that's the $2,000 risk we have on the trade plus the $30 debit, which is showing up right there in red. Now this trade is going to be slower. No matter what happens, it's going to be a slower trade because it's for March expiration. So it's still about 56 days away from expiration or so. And we won't ride this all the way to expiration. We definitely won't be doing that. But what we want to do here is just take advantage of that time decay. We have a nice wide butterfly. The market's right there at the long put right now, and you can see we're a little bit profitable, about 80 bucks profitable. Now that's not much, I realize that, but this is not something we're trying to pull profit out of in a week or two. This is something that's going to take a little bit more time. So again, what we see here in the solid purple line is the expiration profit loss. So for example, if the market finished right at 1850 at our shorts, which is not going to happen, but if it did, we would make how much? Well, we would make that whole 50-point income side of the spread right there. We would make that whole 50 points. That's $5,000 on one contract. Now if you subtract that 30 cents from that, it's $4,070 right there, $4,970. That's how much we would make if the market would expire right at 1850, because our long spread that we own will be in the money, and the short spread that we sold will be out of the money. So we would make 50 points on the long spread, and the short spread, the credit side, would go out worthless. So this trade requires no action right now. There's no reason to touch this, no reason to do anything else with it. We're going to leave it as is and not do anything else. Okay, so our Greeks are still not showing up here on this 1780. I'm not sure why that is, but either way, this thing's positive theta, and we would see that if we had this Greek here filled in. Now, the Greek that's not filling in it's an option we own. It's the 1780 that we own. So what that's going to show up as, if those numbers were filled in, that's going to take away. That's going to make this theta smaller. Right now it's 58. It's showing that we're bleeding $58 a day positive that's coming to us. That's not accurate, because if this number here was filled in as 1780, this is going to be lower, because we're going to subtract that much theta, because that's an option we own. That 1780 is an option we own. So any time decay that option is experiencing is coming out of our pocket. So this really isn't 58. It's probably more like 40, something like that. So, but still, really good trade. And as we go through the days here, you can see this thing start to bump up. The dotted line here, you can see it start to bump up as it's doing. You see that? So, and if we can just ride this thing another month or so. I mean, let's say we ride it a month into the 26th. Now, look all this profit zone. See all this dotted line? All that is, if the market's anywhere where this dotted line is crossing above the zero line, the little white line there, this is all profitable territory. If the market's anywhere in this area. So if the market's still sitting here, we would have about $533 profit in a month from now. No, that's not a lot. I realize that's not a ton of money, but we're basing it on a $2,030 risk, right? So that's a big percentage return. We're doing well there, doing very well. So that's that trade. Now, the other one that we have on right now is also faring pretty well. Here's our unbalanced condor that we used we bought some put spreads here to hedge this a while back. Now, I will tell you, I don't remember last update if I talked about this or not. No, because I did it on Friday. But on Friday, when the market was rallying pretty good, I ended up selling back this spread right here. This is the 1865.55 that I bought for like I think it was like $4.40 that cost, and I ended up selling that thing back for about $2.70 if I'm not mistaken. And so I don't have this little bump here in my trade because I sold that back. Now that put me at a little bit greater debit up here on this side, right? And don't forget, I did roll down my shorts from 1800, 1780. I ended up rolling them down on that big down day we had where the market took that big giant 60-some point dip and then turned around and came right back up. I ended up rolling down those shorts to 1760.40, and that cost me some extra money too. So I don't have this exact position on, but the position we have on here in the Market Insights, as you can see, it has $590 profit in it right now. Right there's our long put at 1910, and the market's right there now at 1903.72. It's bouncing around just very little. It's lunchtime, so that's to be expected. But what we would really like to see out of this thing, number one, we can get out of it right now. No doubt, just get out of it, take our $580 profit. That's based on 74.50 in risk. So I don't have my calculator handy, but that's what is that, about 8% or so. If we take 565, it's bouncing around 565, 595, and divide it by that 74.50 risk. So we're doing very well on this. But again, we own the 1910 put. We're short the 1890, and the market is kind of right in the middle of them there. Not right in the middle, but it's 5 points. Our long put's 5 points in the money. So what I would prefer, usually what you prefer isn't what always happens, but what I would prefer is for the market to pull on back as we go through the next week and a half. I would like the market to pull on back into here. That would be a real treat if we could get that kind of action. But who knows? Unpredictable, completely unpredictable. I would have had no idea that the market was going to bounce like it has. I was hoping it traded on down and followed yesterday's action, but it just didn't happen. So a couple of things here. If we did want to, and I'm just giving you some tidbits to think about. If we did want to, we could sell back that 1865. We could sell back the 1865 put that we own, and we could buy back the 1855. And let's see what those are going for. See, we're at 450. We're at a 450 debit now. Let's put those in and see what that happens. What happens to that? Messed up. Sorry, excuse me. Just a minute. So that's going to take us to $2. So basically from $4.50 to $2. So that's and you see what happened to the graph. You see that, how it flattened out. It took that bump out if we sell that spread back. So we could sell it back right now for $2.50. That's what it's going for, because we were at $4.50 debit. But if we take it out, we go back to a $4.50 debit. So we could sell that thing for $2.50. That's how much credit we would receive from selling back that spread right here, which is the 1865, 1855. We would receive $2.50 credit on that, which is good. It's pretty cool, right? So and right now there's really no use to still have this in here. So we could just go ahead and sell it back and lose it right now. And let's add that in. Let's add that in for practice here. So let's say we're going to sell back, and we're doing this because we no longer feel threatened by the downside. We no longer feel like we need to watch our downside and worry about the market heading down. So we don't need that extra protection anymore. We only have a week and a half in this thing. If the market crashes on us at this point, we can deal with it pretty quickly. So if we sell back that 1865 and buy back the 1855 put, and let's see what the mid prices are. So those prices are 1605 and 1355. So I'm going to add those in as fills. So 1605 and 1350 is what they're currently going for. So there we go. That will put us right where we want to be. And what you'll notice, and if you didn't notice, rewind it just a little bit and look at it. Our risk on the upside here, our expiration day risk, it actually got bumped up a little bit. It's not as bad now, simply because we received some credit in. So it brought this risk of us finishing above 1910. It brought that up a little. Okay. So we're in good shape there. But either way, folks, right now, you know the trade's going for, let's call it $600 to make the math easy. It's bouncing around again. But it's going for $600, and here on the downside risk now that we took that extra spread out, we have $81.95. So just take 600 divided by 81.95. That should give you about an 8% return or so. Now just keep in mind, if we just tread forward a few days and don't see too much, we still have a very nice wide profit area here to trade in. All right, so that's pretty cool. So we're in good shape on this trade also. Again, I'm not in any hurry to do anything else here. Now let me share a couple other things with you. If we're still trading water, maybe at the end of this week, and we're right here in this area, you do have the option, the choice to go back into the market and sell this spread, this 1910 1890 spread. You could sell it back out to the market for whatever credit it's going for. Now right now, just looking at it, it's probably going for about $8 or $9, just based on where the market is. That spread's going for about $8 or $9. So you could sell that back out and get paid $8 or $9 credit, and all you have left on the downside is your 1880 1760 shorts. That's all. I'm sorry, your 1800. I'm sorry, your 1800. I'm getting this trade and my own trades mixed up. The 1800 1780 short spread. That's all you would have left on the downside. So it's basically like you're short a 20-point wide credit spread at 1800 1780 with no protection. Keep in mind, no protection except the big credit you have. And I don't think we can add that many more legs into this. No, we're maxed out on the number of legs. But let's just look here real quick at the at selling back a it's a bear put spread that we're selling back. All right, so let's look at that and see what that's pricing for. And that's the 1910 and the and the other one is the 1890. Let's see. I'm doing something wrong here. I'm not extremely familiar with the way this page here works. So I'll tell you what we'll do. Let's just go to the chain and look at the numbers. So again, all we want to look at is the February 5th expiration. There it is. And so what we're looking at now is the 1910. There's the 1910. That's going for that's bouncing around. We'll call it. We could sell that one back for 32.90. Keep that in your head, 32.90, and we could buy back the 1890 for 20. Let's write this down. 32.90, and we could sell back the 1890. I'm sorry, buy back the 1890 for 24.10. So 880 is what that's going for. So that one's going for 880. So again, just to recap what I just said, we could sell back this portion of the spread, the 1910, 1890. We could sell it back right now for 880, right? 880, and that would bring in $880 credit. Times how many contracts? Well, we own 2 of them here in this example, so that would bring in $1,760, right? That's what that would bring in for us. But folks, it's a good profitable trade right now. 8% or so. I mean, it's you can't complain about that. That's good. So we're in good shape either way. But that's just something else we could do. Now keep in mind, if you did sell that spread back, if this spread was sold back for 880, you would have a nice big flat line up here, and I wish I could show it to you, but we're maxed out on the number of strikes that we can fill in. But you would have this slope would be taken out. You would have a nice big flat line from 1800 on up through here quite a ways. But the only thing is that if the market would crash for whatever reason, the Fed minutes come out tomorrow, and there's something that doesn't sit well with traders, and the market starts heading down, then you would need to do something on the downside to protect yourself if it got too bad. I mean, I know it's 103 points away right now to our short put, but stranger things have happened these days. So you gotta remember that the market went down 60-some points the other day on Friday. So we're seeing some big wild springs. And folks, I'm not going to lie to you. This is pretty tough trading in this environment. It really is. It's not an easy way to trade now. Back in 2015, I will tell you, from January up until August, it was a cakewalk. It really was. It was simple, easy. It was almost too easy. And when that happens, just know it's not going to last. It's not going to stay that way forever. But it was almost too easy to make money on these kinds of trades. And there were rarely trades that I ever even touched. But that's not the case now. It's a little bit different. So just keep that in mind. So every trade's different. Everything's handled a little bit differently, and we just have to stay on top of our game here. But right now, I think we're in good shape to hold this another day or so and see what happens. Now we've got a nice wide profit range on it at the moment, so I'm real happy with that. Let's be patient, give it another day or two, and maybe we'll see it pull back into this area here with some time passage, and we'll see some more profit come into this thing. All right. Folks, that's really all I have for you. I know it's been a little bit of a short update, and I do apologize. Like I said, I've got a few things going on that I have to deal with, and I'm going to try to get out of here this evening. And it's about a three and a half hour drive to where my grandma lives, and I'm going to go and check on her and see what's going on with that situation. She's quite a ways up there in years. She's around I think she is 80, and so I'm gonna go check on her and make sure everything's all right. But it's not looking real like a good situation either way. So we'll see what happens. But I'll catch up with you all in a day or so and during the next update. But everyone have a great rest of the day and enjoy the rest of the week. And I will talk to you soon. See you all. Bye bye.